Today we're going to look at elements of your financial risk. We're going to talk about credit, we're going to talk about interest rates, we're going to talk about leveraging your assets and looking at your wealth against assets to see how much you can leverage. So it's going to be somewhat of a long class, but I hope you'll find it very beneficial. So let's get started. Today we're going to talk about managing your farm's financial risk. This is going to be a somewhat lengthy class, so sit back and enjoy it. Agricultural production is a high-risk business. Risks are numerous, they're diverse, and they're substantial. The big three are your production variability in commodity yield and or quality. This is often caused by weather, disease, pests, and biological lags. The second one of the big three is your market and your price. Variability in commodity and input prices. This is often caused by changes in supply, such as production decisions, weather, disease, government regulations, and demand, your consumer's income, the strength of the economy, exports, exchange rates, those types of things. And lastly, just the fact that you have a financial risk, variability in returns to equity capital and in cash flow resulting from the financing you have to incur. This is often subject to discussion and decisions. So here are the objectives of today's class. We're going to define and characterize financial risk, identify sources of financial risk, and note the relationship between leverage and risk. This class should help you determine the appropriate levels of debt and leverage, manage your credit and liquid assets, understand the risk implications of fixed versus variable interest rates, learn how to structure and repay term debt, and understand the relationship between land lease agreements and risk. Risk is the variability in returns to equity capital and in cash flow resulting from financing. Financial risk arises primarily out of the producer's financial obligations to lenders and to leasers. Here is a list of your major sources of financial risk: high debt and financial leverage, availability of credit reserves, your availability of cash or near cash reserves, variability in interest rates, abbreviated repayment schedules for term debt, and leasing arrangements. All risk is interrelated. Financial, production, and marketing risk are all interrelated. An example is the ability to repay term debt is dependent on the grain prices and the yield for the year. You should consider all types of risk when developing a plan for the entire business. Your appropriate level of debt and leverage is dependent on profitability, risk, repayment capacity, and your tolerance for risk. Now let's look at an area that is not well known by most people, which is called financial leverage. So what is it? Leverage, really simply defined, is the debt you have over your net worth. So let's look at three different balance sheets with increasing leverage. Your total assets in A is $200,000, in B is $400,000, and in C is $600,000. Notice that in A you have no debt, but you have $200,000 in B and $400,000 in C. Your net worth is $200,000 in A because you have no debt, but your net worth in B is $200,000 because you have $200,000 in debt from your $400,000 in assets. This is a 1-to-1 ratio. And in C, you have $400,000 in debt, and your net worth is $200,000 because you have to subtract the $400,000 in debt from your total asset worth of $600,000. This is a 2-to-1 ratio of leverage. Simply put, leverage is good if your return on the assets exceeds the cost of the debt. When return on assets exceeds cost of debt, increased leverage increases the return on your equity. Again, let's look at three different cases. Your net worth of $600,000 in your first case, $300,000 in the second case, and $100,000 in the third case. You can see the debt levels here and the total assets resulting from net worth minus your debt. Notice that your return on assets in case 1 is 16%, in case 2 is 20%, and in case 3 is 36%. This is a result of the fact that you are leveraging your equity. Notice in 5, we'll go to the very end here, that you only put in $100,000 and your debt is $500,000, giving you a total asset worth of $600,000. But only $100,000 of that is from your equity. The return on your assets is the same through all three cases, and your interest increases based upon what you are borrowing. However, notice that your return also steadily increases from 16 to 36%. So you're getting a better return with case number 3, or under 5 in this case, where you're only using $100,000 of your money and leveraging that for $500,000 worth of debt. But you're getting a 36% return on that investment. Now let's look at the next scenario. Here's what happens if your return of your total assets is lower than what's going to service your debt. Notice it's only $48,000. So the interest is the same in this case as we saw before, but your return for your net worth goes down because you're not making the money on your return of your investment. Literally, you are losing money where you're going from 8% to 16% and 48% worth of change, but your return on your net worth also decreases substantially. This is high risk, and you have to look at this each time you decide to leverage your assets and borrow money so that you can increase production, or leverage your debt, is what this is all about. So let's simplify it. Leverage is bad if the cost of the debt exceeds the return on your assets. When the cost of debt exceeds return on assets, increased leverage decreases your return on your equity. Ultimately, increases in leverage cause unfavorable events to have a greater adverse impact on business profitability. Here is my recommendation. Don't let your debt leverage exceed 50%. And here's your formula to look at that. When looking at leveraging debt, just assume that if you make $1 on your investment and you have to pay 50 cents in debt, that's 50% like you saw before, then this is probably the maximum that you should leverage. If the debt you incur is a term loan, don't forget that you have to look at your ability to replace capital assets and service this additional term debt. Here is an example of the farm and looking at what's left over after incurring term debt. Notice that at the very bottom, the capital replacement and term debt repayment margin is only $3,000. So you must make sure this is in the black and not in the red. When taking out a term loan, decisions about using additional term debt should be based on several years of term debt repayment margins. The amount of additional debt support by repayment margins depends on the length of the repayment period and, of course, the interest rate. 2. Result in a $10,000 margin in annual premium and interest payments. Here's some examples at $37,000, $94,000, $39,000 at different interest rate like 8%, or $112,000 at 8% for 30 years. Your ultimate goal is to have a positive capital replacement and term debt repayment margin. Ways to do that is to increase financial reserves, increase your personal withdrawals, borrow additional money to buy farm and non-farm capital assets, use equity capital to make down payments or purchase outright farm or non-farm capital assets, reduce reliance on non-farm income, and prepay term debt if interest rates on debt is greater than rate of return for alternative uses of the margin. If you find that you are having negative capital replacement and term debt replacement margins, here are some suggestions to solve that problem. Use savings. Reduce checking account balances, reduce inventory, reduce accounts receivable, and increase accounts payable. So you want to reduce working capital. Restructure existing term debt so that it is repaid over a longer period of time with lower periodic payments. Liquidate capital assets to pay down your debt. Increase farm and non-farm income, and reduce personal withdrawals. Proper structuring of a debt occurs when operating capital debt can be repaid from funds allocated to pay cash operating expenses. Loans for depreciable assets can be repaid by depreciable allocations or allowances, and real estate debt can be repaid from retained earnings. That's your net income after taxes minus personal withdrawals. So let's summarize what we've seen thus far. More leverage can increase earnings when debt capital is used profitably. More leverage increases cash flow and cash flow commitments, and more leverage increases variability of earnings, your principle of increasing risk. Your upper limits, as we saw before in the example of the return on assets at $96,000 versus $48,000 is the profitability of debt use, your ability to properly structure debt repayment obligations, your variability of earnings and cash flow, the effectiveness of risk management in controlling variability of earnings and cash flow, your willingness of the producer or the lender to assume risk, and your desired credit reserve. Up until this point, we haven't really talked about managing your credit reserves. Credit reserve is the difference between the maximum amount a producer could borrow and the amount actually borrowed. In other words, if you have $100,000, like in that one case, and you're going to borrow $500,000, you may not want to borrow that much, and you keep then a credit reserve. So ultimately, credit reserve is the unused borrowing capacity, and it can be used as a source of funds to meet risk-related needs, such as increased borrowing, loan carryover and extensions, deferred loan payments, and sometimes refinancing. The size of your credit reserve is determined by your analysis of financial statements, term debt repayment margins, and analysis of cash flow budget, your risk management policy, and your lender's analysis of the farm's credit worthiness, and your producer's willingness to accept risk. The advantages of a credit reserve as a source of liquidity is that it does not alter asset-liability relationships. You don't have to liquidate assets to get funds, and they're flexible in uses. Now, the disadvantage of a credit reserve as a source of liquidity is that the returns from investment opportunities are foregone when funds are not actually borrowed. Considerable uncertainty about availability and cost of credit when taken from the reserves, and substantial financial control may shift to the lenders when additional borrowing occurs during stress periods. Here are some recommendations on managing your liquid reserves. Liquid reserves kind of serve as a self-insurance program. Also, the value of this liquidity is reflected by the fact that producers maintain low-yielding liquid reserves while paying higher interest rates on debt, sacrificing higher earnings by foregoing investments, and postponing consumption. Here's a list of sources of liquidity in decreasing degree of liquidity. Notice at the very top is cash on hand. It's very hard to beat having readily available cash that you can use when you see opportunity or, through some kind of risk, have to dip into assets to pay off that risk. Here are some things that sometimes determine the availability or have an effect upon your liquidity. Transaction costs, your commissions, transportation, the activity of the market, and the variability of market over time. Contingent tax liabilities, such as the impact of sales of the farm's income-generating capacity, and sale of current assets, i.e. your grain inventory, has small impact relative to the scale of non-concurrent assets like machinery and land. If you find yourself experiencing any of these symptoms, then you have a symptom of liquidity problems. Declining profitability, your buildup of credit card balances, increased activity in past due notes, canceled insurance. If any of this happens to you, you need to look at your liquidity and take actions quickly to solve the problem. In an effort to quickly notice these things, prepare an up-to-date and accurate balance sheet. Do this monthly. Prepare a monthly cash flow projection and work closely with lenders. Always examine possibility of restructuring your debt. Here are some other ways of managing your liquidity. Closely analyze capital assets expenditures. If you don't need something, don't buy it. Evaluate your living costs. Staying at home and eating homemade meals versus going out 2 or 3 times a week can cut down on your expenditures. Aggressively pursue risk management tools and strategies. Now let's look at fixed versus variable interest rates. Fixed rates simply are rates applied to the entire length of the loan repayment period, i.e. they're fixed. The advantages to this is there's no risk of change in the principal or interest payment due to the time of the loan. It doesn't suffer from rising interest rates and what's going on with the market. The disadvantage is that you pay higher interest rates to compensate lenders for assuming risk of change in the interest rate over time. It doesn't benefit from falling interest rate, and it may have higher prepayment penalties. With a variable interest rate, the interest rate may vary during the loan payment period due to the changes in the cost of money to the lender. The advantage of this for the producer is that lower interest rates, you usually get lower interest rates since it assumes risk of interest rate change. The opportunity to benefit from falling interest rates, so if your interest rates go down, it's going to change. The disadvantages are that uncertainty about the future payment obligations, and there's a possibility of higher interest rates. The third type of interest rate is kind of a mix between the two. It's an adjustable rate, combination of fixed and variable rate loans. It applies to long-term loans and commonly refers to as an adjustable rate mortgage, or an ARM. Rates are fixed for a period of time, like the first 5 years, followed by another period when rates may increase or decrease, often subject to the caps. Your risk of rate change is shared between the borrower and the lender, and the advantages to producer are that interest rates are often lowered, and sometimes there is a limit on how much the rate can increase. So, which is best? It's very difficult to determine unless you know future direction of the interest rates. During a period of low interest rates, producers with a higher vulnerable financial situation are generally well advised to use fixed rates. During a period of moderate to high interest rates, producers with a solid financial situation probably are well advised to use variable or ARM loans. Your ability to withstand risk of interest rate changes can determine which term debt repayment margin you're going to use. How much can interest rates increase under alternative cost or revenue scenarios before repayment margin is gone? Your ideal loan repayment obligation occurs when cash earnings over life of the assets are at least as large as the principal plus interest. Loan repayment obligations that do not match the time pattern of cash earnings diminish the farm's cash flow and increase financial risk. The proper structuring of term debt repayment obligations is based on financial analysis of proposed investments in capital assets. Below is an example of a financial investment in a no-till drill. The drill is going to cost $53,750, and it's going to have an 8-year anticipated payment time with a $15,000 salvage value. If purchased, the drill will be pulled by the same power unit not used to pull the rented drill. The average annual repairs on the purchased drill are estimated to be about $3,000. Property taxes on the purchased drill will average around $500 a year, and repairs for the rented drill are always covered by the warranty versus a new machine. And the lease company repays property taxes. You have to take this into consideration. The producer must buy insurance on both the purchased and rented drill. Proposed financing for the purchased drill is $16,125 down 30%, and a remaining loan payment of $37,625. The lender is suggesting a 10% interest rate and 5 equal annual payments of $9,925. Funds for a down payment would come from an alternative use yielding a 6% cash return, leaving a difference of 4%. A sound investment analysis should address 3 key questions. Is the investment profitable? If it's not profitable, don't invest. Will the investment have a cash flow that matches debt repayment obligations? That's your principal and interest. And what is the risk? The investment in the no-till drill is projected to increase average earnings by $1,789. The investment does not heavily affect cash flow since the lender is proposing a 5-year repayment period and is projected to take 6.6 years to retire the principal. Financial risk could be reduced by negotiating for a 7-year repayment plan. What other risks are associated with this investment? And are the $1,789 improved earnings sufficient to compensate for those risks? So let's look at it on a graph now so we can see it clearly. Notice on this chart the total negative impacts. On earnings, it was $10,811, and on your cash flow, it was $6,867. So under your financial analysis, the change in annual earnings of $12,600 has to take away the $10,811 worth of negative impact. This is only going to leave you $1,789 profit over the period. Here it is up to you to determine whether this is really worth the investment or not. Now let's talk about lease terms and risk. Leasing is a widely used method of controlling land. 43% of land farmed in the U.S. is farmed as leased ground. Incidents of leasing and types of leasing are high. About 2/3 of the U.S. leases are cash leases. In the Pacific Northwest, for example, cash rent dominates on irrigated ground and crop sharing areas. The nature and type of the lease can have a major impact on the producer's risk. Crop share leases they have a value of the crop share paid as rent, and it varies with the yield and the crop prices. Yield and price risk are shared by the landowner and the producer. Since the value of the rent varies with the producer's ability to pay, crop share leases have risk advantages for the producer. Less risk often translates to higher rent, since landowners will require more rent to compensate for the added risk. So let's look at fixed rent. Fixed rent has a high risk for producers in that they must pay agreed-upon amounts regardless of the ability to pay. Producer withstands all the risk associated with the variability of yields, price, and costs. The landowner avoids this risk and is therefore often willing to accept a lower rent that would be required on comparable ground with a crop share arrangement. Then, much like the interest topic, we have variable cash rent. Cash rent for base yield and or price is varied according to the change in the yield or the price. An example, base rent varied by price changes. The producer and landowner share in the price risk in these situations, and the producer assumes all the production risk. Here we reflect the base rent varied by price and yield changes. Once again, the producer and the landowner share in both price and yield risk. Lastly, we're going to look at custom farming. Landowners retain control of the land and manages its use under custom farming, which includes paying a fee for hiring labor and machinery services. The landowner assumes production and price risk. Financial risk can be reduced by extending the length of the lease, both for the land and the machinery. Well, that concludes today's class on financial risk management. I hope you've gotten something out of it and can apply it to your finances. Once again, should you have any questions, please email me at dgholloway6@gmail.com. And thanks for attending.